Imagine this. You line up 100 people at age 25. Same city, same chances, same basic skills. No one is famous. No one is born rich. Just normal people with normal lives. Now you fast forward to age 65. Most of them are not free. They are still stressed about bills, still worried about work, still one big problem away from panic, still asking the same painful question. Where did the money go? A few are doing okay, and one or two are truly strong, not just rich in numbers, strong in choices, that can handle problems. They can wait, they can say no, they can stay calm when life gets messy. This is the part that hurts. It is not only luck, it is not only the economy, it is not only bad timing. A huge part of the gap is behavior, small actions, small habits, repeated for years. And the scary part is that most of these habits feel normal. They do not look like big mistakes. They look like daily life. They look like what everyone does. That is why they work like termites. Termites do not break your house in one day. They eat the structure slowly. You do not notice. Then one day something small happens, and the whole thing feels weak. Money habits work the same way. A few bad habits do not ruin you fast. They ruin you quietly. And a few good habits do not change your life fast. They change your life slowly. That is compounding. Compounding is not just a market word. Compounding is a life word. It is the idea that small choices grow into big results when you repeat them for a long time. Now here is the problem with modern money culture. It attacks compounding. It teaches speed. It teaches noise. It teaches you to chase fast wins. It teaches you to feel smart when you act fast and feel dumb when you wait. But wealth does not care about your feelings. Wealth cares about your system, a system that works in calm times, and a system that still works when markets fall and fear rises. So in this video, you are going to learn 5 habits that keep 98% of people poor, not poor as an insult, poor as in stuck with stress, stuck with no room to breathe, stuck with choices that feel forced. These habits are common. They are easy to copy. That is why most people have them. And for each habit, you will also get a replacement rule. Simple rules, easy words, no hype, no magic tricks, no promises. Just a better way to think. A way built on long-term value investing. A way built on patience. A way built on protecting the downside. A way built on acting like an owner, not a gambler. These 5 habits are connected. They feed each other. One habit makes the next habit easier, and together they create a loop that keeps people stuck for life. Here they are, in plain words. Habit 1, they treat investing like a game. Habit 2, they pay any price for a good story. Habit 3, they ignore business strength and focus only on excitement. Habit 4, they build a lifestyle that forces bad choices. Habit 5, they let fear and FOMO control their actions. We will go one by one. And as we go, keep one idea in your head. The goal is not to be perfect. The goal is to stop doing the few things that break compounding. Because compounding is powerful, but it is also fragile. It grows when you let it work. It dies when you keep interrupting it. Now let's start. Habit 1. They treat investing like a game. Most people do not invest. They play. They open an app like it is a slot machine. They look at charts like they are weather maps. They stare at price moves all day. Green days make them feel brave. Red days make them feel sick. They start to believe the point is to win today. But a stock is not a game piece. A stock is a small piece of a real business. A business sells something. A business has costs. A business earns cash or loses cash. A business has good years and bad years. If you forget this, you will act like the crowd. When the crowd is excited, you will chase. When the crowd is scared, you will run. And this is how people get trapped. They buy high because it feels safe. They sell low because it feels painful. They repeat it. They call it learning. But it is not learning. It is emotion. Here is the hard truth. A lot of people do not lose money because they are dumb. They lose money because they are trained to react. They are trained by alerts, trained by headlines, trained by social media, trained by people who get paid when you click and trade. So they trade more, they change plans more, they jump to the next hot thing. And each jump costs something. Sometimes fees, sometimes taxes. But the biggest cost is mental. They break their own trust. They never build a steady plan. They never stay long enough for compounding to show up. So what is the replacement? The replacement is owner thinking. Owner thinking sounds simple, but it changes everything. Owners do not ask, will this go up this week? Owners ask, what is this business worth over time? Owners ask, will this business still be strong in 5 or 10 years? Owners ask, does it have an edge that lasts? Owners ask, is the price fair or is it crazy? Here is a simple tool that helps you think like an owner. It is called the owner sentence. Before you put money into anything, write one clear sentence. I own this because blank. One sentence, not a paragraph, not a story. One sentence in simple words. If you cannot write the sentence, you do not understand it. And if you do not understand it, you will not hold it when it gets scary. Fear attacks. Confusion first. When prices drop, your brain will say, you never knew what this was anyway. That is why clear thinking before you buy matters. So the first rule is this. Do not buy anything you cannot explain simply. If you need hype to feel sure, you are not sure. If you need a loud person online to hold your hand, you are not ready. That is not shame, that is safety. This is what keeps people out of trouble. Now here is another small rule. Stop checking prices all day. If you check 20 times a day, you train your brain to feel 20 times a day. That is not investing. That is stress practice. A calm investor does not need constant updates. A calm investor needs clear reasons. They check less. They think more. They write down what matters. They focus on the business, not the noise. And there is one more part of habit one that keeps people poor. They invest outside their understanding. They buy what is trending. They buy what sounds smart. They buy what everyone is talking about, but they do not know what it is. That is dangerous, because if you do not understand what you own, you cannot judge it. You cannot tell the difference between a normal drop and a real problem. So you react. You sell at the wrong time, or you hold something weak for too long because you do not know what to watch. This is why a circle of understanding matters. You do not need to understand everything. You only need to stay inside what you can learn and explain. Being honest about what you do not know is not weakness, it is wisdom. Most people want to look smart. Strong investors want to stay safe. So let's lock in the replacement for habit. 1. Think like an owner. Use the owner sentence. Stay inside what you can explain. Check prices lower. Make decisions with reasons, not feelings. If you do that, you already avoid a trap that keeps millions of people stuck. Now we move to habit 2. This habit looks smart. It even sounds smart. But it is one of the most expensive habits in investing. Habit 2. They pay any price for a good story. Here is how it happens. Someone finds a great company. The product is popular. The brand is loved. The future sounds bright. Then the brain stops. People assume a great company must be a great investment, but that is not true. A great business can be a terrible deal, because the price can be too high. Price is not a small detail. Price is part of risk. If you pay too much, you can be right about the business and still be disappointed. You can buy something strong and still lose money for a long time. Not because the company failed, because you paid a price that left no room for mistakes, no room for bad news, no room for a normal slowdown. This is where most people get confused. They think risk means the stock is moving, but a lot of real risk is hidden inside the price you pay. Here is a simple example. If someone sells you a bottle of water for $1, fine. If someone sells you the same bottle of water for $100, the water did not change. The price did, and the price changed the deal. A good deal became a bad deal. That is what happens in markets. In hype times, prices can get silly. People do not want to miss out. They tell themselves, I'm long-term. But long-term is not a magic word. Long-term does not protect you from overpaying. If you overpay, you start your journey in a hole. Now the big question is this. How do you stop yourself from overpaying? How do you stay calm when everyone else is excited? How do you buy with logic, not fear? The answer is a simple idea that serious long-term investors use: margin of safety. Margin of safety means you leave room for being wrong, because you will be wrong sometimes. Everyone is. You do not need perfect forecasts. You need space. Space between the price and what you think the business is worth. Space between you and panic. Space that helps you stay calm when markets swing. Habit 2 is the habit of overpaying. It happens when a good story feels safer than doing the hard work. People hear great company and they stop thinking. They assume the future will be perfect. They assume the price does not matter. They assume the crowd cannot be wrong. But crowds are wrong all the time. In markets, the most loved ideas often become the most expensive ideas. And expensive ideas carry a hidden risk. The risk is that the future must be amazing just to make the price make sense. That is a fragile plan, because life is not smooth. Sales slow, sometimes. Costs rise sometimes. Competitors fight back. New rules show up. A great business can still have a rough year. When you pay a very high price, you give yourself no room for that normal roughness. So the key is not to find perfect companies. The key is to avoid bad deals. A bad deal is not always a bad business. A bad deal is often a good business at a bad price. Here is a simple way to think about it. Value is what you get over time. Price is what you pay today. Most people only look at price. They treat price like truth, but price is often just mood. Value is closer to reality. Value is based on what the business can earn and keep over many years. Being ahead means you can hold two thoughts at once. This business looks strong, and I still might pass if the price is too high. That second sentence is rare, because passing feels like missing out, and missing out hurts the ego, but overpaying hurts the bank account. So you choose which pain you want, small ego pain now or big money pain later. This is where margin of safety matters. Margin of safety is a simple idea. It means you leave space for being wrong. It means you do not buy at a price that requires a perfect future. It means you respect uncertainty. You do not need a math formula to understand this. You just need a few honest questions. Here is a plain margin of safety check. Ask, if the next few years are just okay, does this still make sense? Ask, if the price drops a lot, will I still feel calm owning this business? Ask, am I buying because I understand the business or because I feel FOMO? That last question is the mirror. FOMO makes people rush. FOMO makes people ignore price. FOMO makes people chase the hottest thing at the hottest moment, and then they call it long-term. But long-term is not a label. Long-term is behavior. Long-term means you can wait for a better deal. Long-term means you do not need to act today just because others are loud. Here is a simple inner talk that protects you. I do not need every opportunity. I only need good decisions. Repeated. I can be wrong sometimes and still do well if I avoid big mistakes. I would rather wait than overpay. If you can say that and mean it, you have a real edge. Because most people cannot wait. They confuse patience with weakness. But patience is strength, and patience is what lets compounding work. Now we move to habit 3. This habit is the reason people get trapped in weak investments. They fall in love with excitement and ignore strength. Habit 3. They ignore business quality and buy fragile businesses. Fragile businesses look fine in good times. In good times, money is easy. Customers spend more. Debt feels cheap. Risk feels low. So weak businesses can hide. They can grow fast. They can look like winners. And then the cycle changes. The economy slows. Rates rise. Customers cut back. Suddenly the business that looked unstoppable becomes stressed. This is when you learn what you really own. Being ahead means you care about business quality before the storm. Business quality is not a fancy word. It just means the business can stay alive and keep earning through bad times. Strong businesses usually have a few simple traits. They sell something people keep buying. They have an edge that is hard to copy. They can raise prices without losing too many customers. They do not need constant borrowing just to survive. This is where the idea of an economic moat comes in. A moat is what protects profits. A moat is the reason a business can defend itself. Without a moat, business becomes a fight. Fights crush profits over time. Now, a moat does not need to be complicated. You can spot it with plain questions. Here is a simple moat checklist. Do customers stay for years? Is it annoying or risky for customers to switch? Does the product become better as more people use it? Is the brand trusted enough that customers pay more without thinking? Does the business have a cost advantage that others can't match easily? Does it have a special way to reach customers that others don't have? You do not need yes to all of these, but you want at least one strong reason the business is protected. Now add one more important layer. Even a business with a moat can be weak if its balance sheet is weak. The balance sheet is the structure. It is the business's strength under the hood. In simple words, it answers this question. Can this business survive a tough year without begging for help? A weak balance sheet is like a car with bad brakes. It looks fine on a smooth road, but it is dangerous when the road turns. A lot of people ignore this because it is boring. They prefer the story. They prefer the growth chart. They prefer the hype. But strength is what matters when conditions get worse. So here is a very simple balance sheet check. Does the business have cash? Is debt reasonable? Can it pay interest without stress? Does it depend on refinancing all the time? If answers make you nervous, that is a warning. Because in hard times, debt removes options, and options are survival. This is also why business quality and valuation are connected. If a business is fragile, you should demand a bigger margin of safety. If a business is strong, you still want a margin of safety, but you are dealing with less fragility. Here is the replacement rule for habit 3. Use a one-page business quality checklist before you get excited. Ask 5 calm questions. Do people need this product often? Does the business have pricing power? Is there a moat that protects it? Is the balance sheet strong enough for bad times? Is this a real business or just a trend? If you can answer those, you are already thinking like a long-term owner. Now we move to habit 4. This habit happens outside the market, but it controls your investing more than you think. Habit 4. They build a lifestyle that forces bad choices. People think the market is the main risk. Often it is not. Often the real risk is personal. High bills, high debt, no buffer, a lifestyle that needs perfect income every month. When you live that way, you get forced, and forced people make expensive choices. They sell at the wrong time. They borrow at bad rates. They take bad deals. They stop investing when it matters most. And they do all of it not because they are weak. They do it because they have no space. This is why lifestyle creep is so dangerous. Lifestyle creep is when your spending grows every time income grows. A raise comes in, then the car upgrade, then the bigger rent, then the new subscriptions, then the I deserve it spending. It feels like progress, but it quietly locks you into fixed payments. Fixed payments are heavy. They do not bend when life changes. And when the market drops or a job gets shaky, fixed payments turn stress into panic. Being ahead means you build your life so it can take a hit. You build breathing room. You build a base. And that base is your real margin of safety, not for stocks, for your life. Here is a simple base framework. First, know your essential monthly costs, not fun spending. Essentials: housing, food, utilities, transport, basic insurance, medicine, minimum debt payments. Second, build a buffer. Even a small buffer changes how you think. It gives you time. It keeps you from panic. Third, reduce high-interest debt. High-interest debt is a leak. It steals future you. It makes every month harder, and it makes you easier to force. Fourth, lower fixed payments when you can. Lower fixed payments means more flexibility. More flexibility means better decisions. Here is the replacement rule for habit 4. Become hard to force. Make that your main goal. Because once you are hard to force, you can invest with a clear head. And a clear head is a huge advantage in a world full of noise. Here is a simple inner talk for this habit. I want freedom more than I want upgrades. I want options more than I want status. I want a calm base so I can act smart when others panic. Habit 5 is the most common reason people stay stuck. It does not look like a money problem at first. It looks like an emotion problem. Habit 5. They let fear and FOMO drive their decisions. This habit hits in 2 moments. First, when things are going up. Second, when things are going down. When prices go up fast, people feel FOMO. They feel late. They feel left out. They think, if I don't buy now, I'll miss it. So they buy fast. They buy without a plan. They buy without a margin of safety. They buy because the crowd is excited. Then prices fall. When prices fall fast, people feel fear. They feel pain. They feel regret. They think, I need to do something. So they sell. They sell without checking facts. They sell because the crowd is scared. This is the cycle. Buy from excitement. Sell from fear. Repeat. This is not investing. This is emotion. This is why the market feels like a machine that takes money from people, because it does. It takes money from people who cannot control their actions. Now, here is a hard truth. The market will always test you. You cannot avoid that. If you want long-term results, you must accept short-term swings. That is the price of entry. So the question becomes simple. How do you stop fear and FOMO from running your money life? You need a system, not motivation. Motivation fades. A system stays. The replacement rule for habit 5 is a calm protocol. A calm protocol is what you do when you cannot trust your feelings. Because in a hot moment, your brain lies, fear lies. It says this will never end. Greed lies. It says this will never stop going up. So you need steps, simple steps. Here is the calm protocol. Step 1, pause. Do not act right away. You do not need to win the next 10 minutes. You need to protect the next 10 years. So pause. Step 2, name the feeling. Say it clearly. I feel FOMO. Or I feel fear. This matters because naming a feeling makes it smaller. It turns panic into a fact you can handle. Step 3, ask one key question. Did the business change or did the mood change? Most of the time, the mood changed. Headlines got loud. People got emotional. Prices moved fast. But the business is still the business. That is why owner thinking matters. It pulls you back to reality. Step 4, use your checklist. This is the checklist for red days. Are customers still there? Is the balance sheet still strong? Is the business still earning real cash? Is the moat still there? Is the long-term story still true? You are not guessing the next week. You are checking the foundation. Step 5, use a time rule. Never make a big money decision in a hot state. Wait 24 hours. One day can save you from a lifetime mistake. This is not laziness. This is wisdom. Now, some people will say, but what if I miss something? Here is the answer. If your plan depends on speed, it is fragile. A strong plan does not need perfect timing. A strong plan needs good decisions made. Slowly. Because slow decisions are usually more rational. Fast decisions are usually emotional. Now, there is another part of this habit that is very modern. Information overload. Most people think more information makes them smarter. But too much information makes you reactive. News pushes fear. Social media pushes hype. Day trading culture pushes action. And action feels like control. But most action is just stress. So being ahead means you protect your attention. Attention is like money. If you spend it on noise, you have less for real thinking. So set limits. Simple limits. A simple rule could be, I check markets once a day, not all day. Or, I do not follow hype accounts. Or, if something is trending, I slow down. These rules are not strict to punish you. They are there to protect you. Because your attention controls your emotions. Your emotions control your actions. Your actions control your results. Now, there is one more rule that matters a lot, position size. Most people ignore this. They buy too much of something. Then a normal drop feels like a disaster, and they panic. So the rule is simple. Never hold more of something than you can hold calmly. If a drop can ruin your sleep, the position is too big. Sleep is not a small thing. Sleep is risk control. Risk control is long-term survival. Now, let's tie all 5 habits together. These are the 5 habits that keep 98% of people poor. They treat investing like a game, not ownership. They pay any price for a good story. They ignore business quality and buy fragile companies. They build a lifestyle that forces bad choices. They let fear and FOMO drive decisions. And here is the best part. Every one of these habits has a simple replacement. Owner thinking instead of guessing. Margin of safety instead of hype pricing. Business quality and moats instead of fragile trends. A strong personal base instead of forced choices. A calm protocol instead of panic. Now, do not try to fix everything today. That is another trap. Pick one habit, just one, and pick one replacement rule. Then repeat it until it becomes normal. Here are 5 simple starting actions. Write an owner sentence for what you own. Write a 1-page business checklist for quality and moats. Write your margin of safety questions on a note. Write down your essential monthly costs and your cash runway. Write your calm protocol and keep it near you. Small steps, simple steps, done consistently. This is how real wealth is built. Not with big wins, not with luck, not with hype, with patience, with safety, with clear thinking. And this is the final idea. Compounding is powerful, but it needs time. and it needs you to not ruin it. You do not need to be the smartest person. You need to be the calmest person. You need to be the person who does not get forced, the person who can wait, the person who buys with a margin of safety, the person who ignores the noise, the person who thinks like an owner. That is how you stop being stuck. That is how you stop being average. That is how you stop staying poor. If you want to take action right now, do this. Write down which of the 5 habits is your biggest problem. Then write down the one rule you will use to replace it. Keep it small, keep it real, and start today, not tomorrow.